I'm Wyatt Wells, and my company is Ardmore Shipping Corporation, which is a company that focuses on the transportation of product and chemicals through sea tankers all across the world. They have a fleet of about 19 ships, and it's one of the more modern fleets in the industry, mainly because it just started operations in about 2010. So let's get into it. So, starting with the income statement, one of the things to look at is their loss and depreciation of assets. Each year, they've increased the total amount of depreciation they have. This means that each year they have gained more assets um, and replaced the ones that are losing value. So, this is good because they're replacing the old with the new, um, which is just going to make their company better. And then another important aspect to look at is the earnings per share. They've had an decreasing earnings per share since 2014, turning negative in 2017. This is definitely a red flag for investors um, because it means that the company is not being profitable. Um, this could be because they had a big expense that year. However, this is most likely not the case because they've been decreasing for the past 4 years and just going further into the negatives for the past two. Um, this also is because their margins are getting crushed because COGS is outgrowing their sales. Um, so then in the next part to look at is their balance sheet. One of the main sections to look at is their current assets and cash. Ardmore Shipping Corporation has a pretty steady amount of cash with very little fluctuations. Having steady cash allows them to continue operations, so it's a pretty good thing. They also have a pretty stable accounts receivable. This means that they are allowing about the same amount of people to use their product on credit. This is the amount they are expected to bring in because the customers pay for the service. It also shows that they're able to liquefy their assets without using cash. They've managed the amount of credit extended pretty well because of that. Another thing to take a look at is their retained earnings. Since 2005, it's been decreasing, and then in 2017, it dropped into the negatives with a significant loss in 2018. This is not a good sign because it means that the company has retained significant losses in its existence over profits. So then we can move on to the cash flow statement, and one of the important things to look at there is cash flow from financing. It could the value could either be positive or negative depending on what the company's been doing. Ardmore Shipping Corporation has had a positive amount every year except in 2017. The positive value means they have money coming in to boost its assets. The negative balance could be because they paid off some long-term debt, and since they are a company that is losing money, they need to raise their capital to make up for it. So those losses in 2017 raised the capital. Yeah, and so the next part would be cash flow from investing. And these numbers should be negative, and Ardmore Shipping Corporations are. The purchasing significantly decreased from 2016 to 2017, dropping from negative 174 to negative 2. This is because they are probably a new business, so they did a lot of their spending early on, and now they don't have the need for as many new things. So then you can look at cash flow from operations. Ardmore Shipping Corporation has had all positive values, so it has money that it can use to expand or maintain its operating expenses. And then the final section to look at is their repayment of long-term debt. This number has increased over the years, and that's a good thing because that means they're growing and they're able to pay off more of their long-term debt, which includes loans. It also shows that they're keeping up with their debt and chipping away at it a little at a time and not just letting it pile up. So then we can go into the growth. And so since they are a relatively new company, they experienced a very high ratio of growth early on. And that rate skyrocketed in 2015, and since those unsustainable high rates can't last forever, they experienced a year in 2016 with very little to no growth, which was shown by a decrease in revenue, operating income, and net income. The growth from being used more because they just started out and were becoming popular, and they were able to invest in more shipping space. So then we can kind of go to the profitability side. In 2015, return on assets, return on equity, and return on invested capital all hit their all-time highs. Then they experienced significant drops in 2016. And this drop is probably because their overall net income dropped, which makes a lot of sense because they all experienced a drop, not just one of them. Like all three of those major things experienced it. And so then the next thing to look at would be profitability and gross margins. It has a very similar shape to return on assets and return on equity, increasing, and then with that drop in 2016. They also have had a pretty low gross margin in 2018 with about 21%. That means they're only making 21 cents per dollar of revenue. And they could fix that, by finding cheaper means of production or increasing the price of their product. The operating margin also has the same shape as gross margin. Some red flags, though, are that it did have a negative value in 2018 for operating margin, which means it had no money to pay non-operating costs like taxes. And so moving on into the financial health, it has a high debt to equity ratio, which would definitely be a big red flag for investors. And then in 2016, they started taking on more debt and a higher interest rate, which is pretty bad because they already had a significant amount of debt, and bringing on more of it is just kind of growing that red flag they have in the debt section. But their current ratio and quick ratio have been able to stay above 1, which means they're able to make their yearly payments and cover their current liabilities. So that is a good thing. And so then switching gears from finances to the management side, they have a pretty decent management. Compensation is pretty good with $2.4 million to senior executive officers. They get bonuses for being on committees or heading up chairs. They also receive stock in the company so that their views align with those of the stockholders. The character is also pretty good. When you look at their transactions, Ardmore Shipping Corporation bought back shares from GE Holding, which was their largest shareholder. And that upset some of their board members and ultimately led to 2 of them stepping down, which, could be good, bad, losing 2, but it's making sure their board is aligned with the views of the shareholders. And it also shows that it's not a stacked board. And another thing that does that is that they have staggered elections, so they're getting new people every 2 years instead of just completely getting rid of their board and bringing in a new one. Their operations are also very good. They're straightforward, even though they might not have the best financials. They're straightforward, and they try to implement the practices that they say. So, like being eco-friendly, they try to do that. So, some red flags: declining cash flow. Cash flow from operation is decreasing. Which is pretty bad because that's how the business operates. So that's not a good sign that it's decreasing. They pay bills, but if they don't, they already have like the negative income. So if they quit being able to pay those bills, then it's going to go really bad really quick. So then looking at the valuation, a few things about valuation. The price per book was under 1 since 2014. When it was less than 1, that usually means there's financial distress, bankruptcy, or plunges in earning power. And since it's been under 1 for a significant amount of time, that's a very bad sign. And then the price per share is about the same as the rest of the industry, but it doesn't take into account debt, which Ardmore Shipping Company has a lot of. Price per cash flow, pretty consistent with competitors, but below industry average, which means there's room to grow, but there's a lot of red flags. So even though there is that room to grow, it's pretty hazy. And so then finally looking at yield, there's a decent loss in 2017, going into the negatives again, and then again continuing to decrease in 2018. Which means it's a pretty bad sign because it means the company isn't being profitable and is just continuing to go down. So the company is probably undervalued compared to the rest of the market, but there are a lot of red flags when it comes to that valuation. So if I had to make a recommendation, it would be not to invest in Ardmore Shipping Company. If you already have the stock, sorry, but I would probably sell it because I don't see it going anywhere good. There's a lot of risk involved with it. Every company has the ability to possibly go up, but this one just has a lot of red flags with it. Not just in one section, but kind of throughout, like their whole company, red flags pop up. So I would not recommend buying this company, especially since it's just kind of really started to go downhill these past 2 years. So thanks for watching and happy investing.